Hey everyone, welcome back to Corporate Decoder, the place where we try to decipher what corporate filings are actually saying. Today, we're tackling a whole stack of documents from Hartford Series Fund, and let me tell you, this is going to be fun in a trying to understand a foreign language kind of way. Think expense ratios, asset allocations, and enough risk disclosures to make your head spin. So grab your metaphorical decoder rings and let's dive into the financial funhouse that is Hartford Series Fund Inc. First up. Okay, this is the section where we're going to spend the most time because it's really just a collection of reports that the company sends out to its investors. Think of it as the highlight reel of their year. We're focusing on the Hartford Balanced HLS Fund, Class IA shares here. And right off the bat, they tell us where to find even more info, hartfordfunds.com/reports-HLS if you want to fall down the rabbit hole yourself. Let's talk money. What did it cost to run this fund? The report uses a hypothetical $10,000 investment. For the Class IA shares, it would cost you $67. But get this, that doesn't even include transaction fees from your variable life insurance or annuity. Think of this as the base price with all the add-ons sold separately. The expense ratio, the costs paid as a percentage of your investment was. This is important because it eats into your returns. So how'd they actually do? Well, US equities did pretty well, driven by, you guessed it, megacap tech companies and AI hype. Most fixed income did okay too. Now, this fund has a blended benchmark, which is a mix of the S&P 500, US government credit bond index, and some treasury bills. The fund unfortunately didn't do as well as their benchmark. So what worked? Picking stocks in financials, energy, and healthcare. Being overweight in financials and underweight in materials also helped. Targa Resources, Broadcom, and Corning were individual stock picks that did especially well. In fixed income, security selection within investment-grade corporate credit helped boost returns, and security selections within taxable municipal bonds also contributed to relative performance. What didn't work? Stock selection was the primary detractor, and the biggest culprits were missing out on Nvidia and Meta, plus an overweight position in Elevance Health. Numbers time. Class IA shares returned 11.21% for the year, 8.09% over 5 years, and 7.75% over 10 years. For comparison, the blended benchmark did 15.25% in the last year, 8.88% over 5 years, and 8.61% over 10. This means that it did not keep up with its own benchmark index this year. Here are some other key stats. The fund's net assets are about $1.6 billion with 494 portfolio holdings, and the portfolio turnover rate, or how frequently the fund replaces its holdings, is 50%. Where did they invest? About 65% was in common stocks, 21% in US government securities, and 10% in corporate bonds. This kind of split is pretty typical for a fund trying to balance risk and return. Now let's see what we can learn from the next fund. Hartford Balanced HLS Fund Class IB shares, which has almost all the same info, but just in a different class that charges more for fees. Indeed, their expense ratio is percent or $93 for a $10,000 investment. The average returns are almost the same, but slightly lower, reflecting the higher fee, 10.94% for the last year, 7.83% over 5 years, and 7.48% over 10 years. As we scroll through other funds like Hartford Capital Appreciation HLS Fund Class IA shares, they all share much of the same risks, management discussion, and basic data. Instead, let's move on to what is specific about the Capital Appreciation Fund. This fund performed in relation to the Russell 3000 index. Basically, this report says that the market was a bit of a roller coaster due to inflation worries, interest rate adjustments, and of course, election jitters. The fund's success came mostly from underweighting healthcare and consumer discretionary stocks while favoring communication services. Apple and ARM holdings were good individual picks, while not having Nvidia in the portfolio was a detractor. This may show an aversion to what the managers see as overvalued AI hype names. The Class IA shares had 21.19% annual return compared to 23.81% for the Russell 3000 index. It made investment management fees of about $24 million. Scroll a bit further and the portfolio holdings is 29% in IT, 12% in financials, 11% in consumer discretionary, and 10% in communications. This fund is heavily tilted toward tech, but not the popular AI names, interestingly. For financial reporting purposes, this sounds like they may use certain leniency and discretion in their reporting standards here. The rest of these funds mostly have the same data and details, so let's head to the important stuff. They do have a code of ethics. It's good that they're checking this because we want to make sure these guys are not trading on insider information. They have also designated David Sung as their audit committee financial expert. This means they have someone who's got serious financial chops overseeing the numbers. Good. Let's talk about the fees paid to their accounting firm, PricewaterhouseCoopers. In 2024, the aggregate fees were about $350,000, about $30,000 more than the year before. They also spent roughly $60,000 on tax services. Now, something to keep an eye on is the all other fees category, which was much higher in 2023 at $846, but a lot lower in 2024 at. They confirm that the audit committee has a policy for approving these services, which is standard. Let's see how much they made in fees overall. That's a pretty good chunk of change. These funds invest primarily in U.S. equities, corporate bonds, and U.S. government securities, which is as expected. They didn't have any specific details about the board of directors' fees, but they are listed at $87K on the statement of operations. So what's our take on Hartford funds? Overall, based on this information, Hartford Series Fund seems to be mostly running as expected. These funds definitely benefit from economies of scale, but are they as competitive as they could be? It's tough to say without digging deeper. It's worth noting that many of their funds did not beat or even keep up with their benchmark index. This is important for investors to be aware of. It is also important that management recognize some issues and are taking steps to improve performance, such as changes to leadership. It will be interesting to observe these funds' performance over the next few years. Also, most investors likely won't care about most of the funds that this SEC filing is about, but the general public that is invested should note how the fund has done in the past and how they may do in the future. That's all for this corporate decoder. If you found this helpful, hit that like button, leave a comment with your thoughts, and be sure to subscribe for more deep dives into the world of finance. Thanks for watching.